Hey, everybody, welcome to the What is Money show. I'm sitting down today with a new star in Bitcoin Twitter, Mr. Mike Alfred. Mike is an independent investor, and he recently sold two software companies, one to our friends over at NYDIG. And Mike and I are going to be talking about the book, The Dao of Capital, written by Mark Spitznagel today, which is a really good book. So, Mike, it's been a long time coming. Welcome to the show.
Yeah, thanks so much. Excited about this. I've been listening to your show. My wife calls you the professor of Bitcoin because you go so deep. And because of the way you talk, she heard you on Twitter Spaces the other day and she was very impressed. So,
well, I am honored. I'll take it. We're just saying offline that, if you're on Bitcoin Twitter and you're not getting praised and or attacked or both, really, then you're not doing it right. So professor seems like a good nickname. I'll take that one.
Yeah, I know a lot about both, by the way. It's been a wild ride since I started using Twitter more actively in June of this year. I never really used it before, and a lot to learn, right? But there's good sides and bad sides to social media as it relates to Bitcoin Twitter, but I'd say it's a net positive for me.
Yeah, it's definitely contentious all the time, very adversarial. But once you, I guess, get used to it, it's sport, It's just a fun place to sharpen yourself and hopefully sharpen others.
I view it as performance art at this point. I think a lot of people are mostly performing, and I've even had situations where I've met people from Bitcoin Twitter in real life, and then they go back on Bitcoin Twitter and start the performance art again. And I can't tell whether they're serious or not because we've already met in person. So I'm not sure, what's going on there, but it's very interesting medium.
Yeah. It's a totally different vibe when you meet someone in real life. It tends to be they tend to be a whole different version of themselves, like very nice, a lot of camaraderie, rah Bitcoin. But then you get back into Bitcoin Twitter. I guess when you get behind the phone or behind the screen, people just get a bit more courageous and vicious sometimes even. But
it's easier to hurl insults when you're not standing face to face with somebody.
Yeah.
The keyboard warriors have a lot of courage, I've found. So
yeah, keyboard warriors, that's right. And yeah, I think you and I've caught myself, people spewing venom at me many times on Bitcoin Twitter. And I've, found myself typing that message like, oh, your mom wants you to get back in the basement, and I want to hit send, but I restrain myself. So.
You have more restraint than me, sir. I'm working on it. By 2022, my one of my focuses will be on calming down my Twitter presence a little bit.
Yeah.
A little bit more gravitas, a little bit more patience, etc. So we'll see if I'm successful.
Yeah. I would like to get to more production focus, less consumption, because I think when you do the consumption, you get entangled in the arguments and all of that. So all that said, we're talking about a book today that is quite sophisticated, very difficult read, but very enlightening. And I think, Spitznagel has done a great job of taking the esoteric Austrian economics study and pulling it into kind of practical investment reality, to the point where he even develops, I believe, two frameworks in the book. He has Austrian Investing 1 and 2, if I recall correctly. Mm-hmm. And you're a little bit fresher on this book because I know you said you just read it. I read this book about a year ago. So I think we'll just jump in and see where we go. So can we talk a little bit about the guy's name is Clip, right? That was his.
He was a trader in the Chicago pit,
and he was right? Spitznagel's. I guess Spitznagel. Yeah, he was Spitznagel's mentor, and the guy was just full of wisdom. So maybe we could just talk a little bit about him first. Like, what's his story? What was the mentorship he provided Spitznagel, and how does it apply to his investment framework later?
Yeah, so Spitznagel, like a lot of great investors in history, was interested in investing from a very young age, right? Like if you look at any great investor, it's like a consistent theme. It's always something they're interested in, usually from a very young age. They start wanting to buy stocks when they're 5, 7, 9 years old, 12 years old, whatever. And so I guess Spitznagel's father knew this trader, Clip. And so he got an invitation one day to actually go and watch kind of from the gallery, the trading floor there in the pit, which I guess is fascinating, right? It doesn't even really exist today, that sort of environment where you have these multiple levels where the biggest traders with the biggest order flow and the biggest customers kind of sit on the outside edge, looking down towards the middle where they can see the process of the trading happening. Whereas the smaller, newer traders like Spitznagel, when he first joined the floor, were down in the middle and getting knocked around by the bigger guys that were up on the outer gallery. So he saw that. He was fascinated with it. There is a component of the book that some people might not like, which is that you see that even Spitznagel's early opportunity set came from his familial relationships. And so people who would like to say, hey, I did it myself and I achieved everything in my life, right, by doing it myself. Like there's almost always a story like this, for people that got a fast start. But Spitznagel got a fast start. He started working for Clip in the pit, I think shortly after he graduated. He originally was put in the middle of the pit doing, basically smaller trades, and Clip taught him from the very beginning that you want to take small losses quickly and frequently. And this is sort of antithetical to a lot of the thinking of investors today who are always looking for kind of a big score, right? They want to make money a lot of the time and they want to make a lot of money. And actually Clip said, hey, the guys who make big scores like that, they are either very lucky and retired, or they're just out of the business, right? He said, if you want to survive on the trading floor here and make money consistently, you need to get good and actually enjoy losing small amounts of money, right? And so he taught him about taking that quick early loss early on, which I think is sort of formative, because if you look at Austrian investing today and the way he practices it, it kind of follows naturally from this methodology of taking one step back or multiple steps back, small steps, in order to take bigger steps forward in the future when the opportunity presents itself. He talks a lot about the local edge, right? So as a market maker, you get paid when people try to cross the bid-ask spread, right? So your privilege is to be able to always transact at that bid or ask as a local as market maker. You can also take that quick early loss, whereas somebody who has immediacy will need to cross that bid-ask spread, and that's where you actually make your money. And he talks a lot about the kind of market routes, what happens when a lot of people are trying to transact immediately. That's when you see these kind of big sell-offs in markets where there's kind of this whoosh that washes out a lot of folks, particularly leverage traders. And so I think Clip was like a centering influence, taught him a lot about how to think about markets, taught him a lot about the differences between people who kind of look at markets like a lottery ticket, right? And are always trying to hit long shots and make big wins, versus people who think of it in a more systematic way and are able to make profits consistently over time, following a consistent methodology of small losses.
Yeah, no, that's a great intro. To your point earlier, like I hate it when people say so-and-so is a self-made man or I'm a self-made man, because no, who's self-made? No one's self-made, right? If you participate in the market,
nobody.
Did you make your laptop? Did you make your mic? Did you make your house? It's like, no, none of us are self-made. We're all interdependent. That's the nature of what's going on here. So I don't know. I take exception to that when people try to claim they're self-made.
It's not just interdependent on other people. It's interdependent on the means of production, which is a big theme of the book, this accumulation of more sophisticated capital structures over time. Yes. You can't create an internet company without a computer, right? You can't create a cryptocurrency without the internet, right? And so that's just one example, but a lot of people like to say, hey, I'm self-made, I did it all myself, but the reality is we're all standing on the shoulders of giants. So I think that's an important point to make.
100%. And yeah, he goes very deep into roundaboutness and how it increases the complexity of production structures. And that's how we become more wealthy, right? And this, the esoteric term, the division of labor, is commonly used in Austrian economics to describe this. But when I'm trying to simplify it for others, I say, look, we all know many hands make light work. That's effectively what the division of labor is. But then you could also take it a step further and say many minds make even lighter work. And we accumulate the mental discoveries of people over time. Like that is civilization, right? We figured out all these ways of satisfying wants, quicker, cheaper, better. So to go back to the book here, he makes Clip's basically teaching him, sell your losers, double down on your winners, something like that. But this is and this gets to another core theme of the book, that a lot of this practical investing strategy is contrary to your intuition. It's counterintuitive in a lot of ways. So I'll read one excerpt here. He writes, quote, "It was nearly impossible to follow and practice consistently. Brutal was Clip's term to describe the formidable challenge of looking beyond the immediate outcome, of retaining depth of field, a challenge that Clip believed was essential to gaining an edge. This was as it should be, indeed. If everyone accepted Clip's paradox, it would no longer be effective. It would no longer even be a paradox." And then here's where he starts tying it into Taoism that I think is interesting. And he's referring to, I guess we would pronounce this Lao Tzu, which was the author of, what is the name of the book?
Dao de Ching.
Dao de Ching. Thank you. And
or lousy, right? I think
lousy.
Two different pronunciations. Yeah.
And I've always read him pronounce Lao Tzu in other texts. So I guess
Lao Tzu. Yep.
Yeah. So we'll go with Lao Tzu here. So from Lao Tzu, who wrote, "The bright path seems dim. Going forward seems like retreat. The easy way seems hard. The highest virtue seems empty. And here are the favorite Taoist images of water in the valley, the Lao Tzu's attitude of lowliness, which water always seeks." And I think what he's referring to there is, I've read this before, is that the Taoist wrote that water is most like the Tao because it flows to the lowest place on earth, but nourishes 10,000 things in its path. So there's something about this like deep ancient wisdom of retreating to advance. There's this paradox of, taking your losses quick and doubling down on your winners. It's contradictory to our instinct, but it is in fact the way, it's the most effective investment strategy.
Yeah, that's right. That's right. And the ancient Chinese philosophy talks about action through inaction, right? Mm-hmm. And that's like one of the key concepts that comes through consistently in the book. And it's manifested in something like Tai Chi, right? Where you actually kind of win by yielding.
Yes.
Right? So you're actually strong by being weak. It's manifested in the game of Wei Chi or Go, or sometimes by yielding positions on the board, you ultimately win. And so it's this sort of doing by not doing. Hard is actually soft, weak is actually strong. Yes. He even refers to false humility, which I find particularly interesting, because a lot of people present this idea of humility as a virtue, like a fundamental virtue. But really, in a way, humility creates this positional advantage, because people believe you're weaker than you are. You can actually become strong at some opportune time in the future and gain a huge advantage on any of your potential opponents. And so in a way, and I've noticed this in business, a lot of the people who talk the most about humility are actually not humble people in the way they actually behave. They're really quite aggressive in the way that they run their business, but they're almost hiding. They're using this kind of false humility to sort of hide in the darkness and appear to be quiet and appear to be weak. And then they spring forth later in a full attack at the moment where the opportunity presents itself. And so there's this concept of shi. It's spelled S-H-I, shi, but I think it's actually pronounced sure or sure, which is this positional advantage that's obtained over time. And so the object of the Taoist, whether in a military battle or in commerce, is to actually achieve this positional advantage over time, relative than going directly at the end goal, which might be to win the war and achieve peace, or the end goal, which might be to build a business. It's to obtain the means to make the ending of the war or the successful business enterprise sort of inevitable through the successive building up of capital over time. And to go back to your original comment, though, there's like this fundamental time arbitrage that I've noticed as an investor, right? And you see it in the markets, particularly right now with ultra low interest rates and obscenely high asset prices, particularly for the most popular assets in the world, like technology equities in the US, for example, where there's this like extreme focus on the here and now. And this inability to even understand that like what matters is not necessarily here and now, because right now is just one snapshot of time. But actually what matters is where's your capital, where is your health, where is your well-being 3 months from now on a Tuesday, 9 months from now on a Wednesday, 2 years from now, right? Because those moments are no less important. But for whatever reason, because of this sort of manipulated low interest rate environment we're in, people are intimately and immediately focused on everything happening in the here and now. And that's counterproductive to obtaining this kind of shore that Spitznagel talks about as coming from the ancient Chinese philosophy, where you want to sort of lie in wait and be patient and wait for the opportunities that are coming in the future, as opposed to simply jumping on the opportunity that you see right now in front of you.
Yeah, it's so well said. A lot of things coming up there for me. This extreme focus on the here and now, I think there's a deep argument to be made that when you corrupt money, basically move to a fiat world, the money's depreciating rapidly. The Austrians describe this as elevating your time preference, that it's really screwing up people's relationship with their future selves, right? This, again, every action you take is effectively a trade with this spectrum of your future selves across time. So if you're considering less and less of those future selves, then you're going to make worse decisions, right? You're going to take on excessive leverage, or you're going to just accumulate some hidden risk in your business, trying to make some short-run gain without considering the longer-term consequences. And it's kind of like you're playing in this fiat environment against people with these higher time preferences. The optimal strategy would be to be inactive, right? To be well capitalized. And this reminds me of that quote. I don't know who said this, but if you wait long enough by the river, you can see the bodies of your enemies float by. It's like being in a strong position, not taking excessive risk, kind of like Buffett's wisdom, right? Being fearful when others are greedy, greedy when others are fearful, trying to be in that position to advance yourself and advance your capital position, which ties into another one of Buffett's quotes. And I'm going to totally screw this one up, but he makes the point. That's one of the hardest things to do in business, is to know when to do nothing and to know when to act. Like a lot of his, I think a lot of his business history is a lot of inaction, actually, right? They're just waiting for people to get washed out in these liquidity cascades or whatever. And then they go in and buy everything for cheap and hold it forever.
Yep. And he says, you only know who's swimming naked when the tide goes out.
Exactly.
Right. And he gets a lot of criticism. I mean, it's every decade or two, he gets a lot of criticism for holding large amounts of cash, but it really is. And Spitznagel highlights this near the end of the book, that it really is a nearly Austrian concept to sit with large amounts of cash. And in fact, his Austrian one, formulation, one way to take advantage of unusually high asset prices is to do absolutely nothing, just refuse to participate in the market. And in his parable of Nibelungen is this place where these three like prototypical Austrian guys, probably wearing lederhosen and with their horns, right, up in the fields in the Alps somewhere, build businesses, right? It's Siegfried, Johann, and Gunther, right? It's Siegfried is this exceptional entrepreneur that earns above his cost of capital. Johann earns approximately the cost of capital, so he's sitting in sort of stasis. And then Gunther is pretty bad at entrepreneurship and is constantly spending down the assets. He's having to sell the land because he's not earning his cost of capital. And so if you use that kind of parable to think about everything, right? Like it tells you that fundamentally, as an investor, you probably only want to be investing in people that can actually earn their cost of capital. The problem is with all of the intervention and artificially low interest rates is that it looks like everybody's earning their cost of capital. And so it lures everybody into the market at increasingly higher asset prices. And that's where Warren Buffett kind of wins. He's seen that movie so many times. He knows the difference between a Gunther and a Johann and a Siegfried, right? It doesn't chase the Gunthers when they look temporarily profitable or temporarily economical at the end of the cycle, and waits for others to get washed out, to see who's swimming naked, to see your enemies floating down the stream. It's all linked together. It's this action, taking action through inaction. It's being patient and waiting for the correct opportunities and accumulating capital in a roundabout way through that patience. So it's all linked together. And actually, as a value investor, a self-professed value investor, I do, all of this kind of resonates with me, although, Spitznagel does make a distinction between Austrians and value investors. I think it's a thin distinction, because I think the way value investing has evolved, it actually looks quite a bit like the kind of his classical definition of Austrian investing. But it comes down to basically refusing to swing when there's no pitch with hitting, right?
Yeah, conserving your energy for the opportune time. And the quote here is, exploiting others' immediacy was the logic of the roundabout approach, the fundamental edge, the ultimate edge of trading and investing. And so I tied this back to something I got from Taleb, which is that time and volatility are like the same thing, right? Volatility occurs over time, inevitably. And so these stressors that come through volatility across time, if you're in an undercapitalized or a leveraged position, this is what causes your need for immediacy, right? All of a sudden you have to act. You're forced to act. And contrarily, if you're in a strong equity position, not leveraged, or you've got a lot of optionality, a lot of cash, whatever, you're basically convex to time at that point. So you are anti-fragile. You're in an anti-fragile position, and you're just waiting for the fragility cascade to unfold. And then you just, go. I'm sure people just send you spreadsheets and they're like, everything's on the fire sale, and you just buy whatever you want and then sit on it. Right. So it's really interesting.
We should mince no words about it. Right. The ultimate objective of obtaining positional advantage is to essentially victimize other people in the economy. It's not that different. It's not that different from poker. If you're a world-class poker player sitting at a table full of, fish, right? You're not going to win every hand, but you're going to sit patiently until you come across situations where you can get your money in with a severe, advantage from a game theory standpoint over your competitors, because if you do that consistently, even with variance, you will eventually win. Now, poker is a zero-sum game where all the profits that go to the winners ultimately come from the losers, net of the house rake. Business is a little bit more interesting, and investing is a little bit more interesting, a little bit more limitless, right? Because multiple people can win in any given simulation of the future, right? But the whole idea of the way that Spitznagel looks at the Chinese philosophy and kind of turns it towards Austrian economics is the whole waiting is not for nothing. You're not building these more advanced capital structures and waiting patiently for no reason. You're waiting because at some point, some intertemporal moment in the future, you're going to use that advantage to systematically exploit that economic advantage for profit in a way that, let's call it what it is, may hurt other participants in the economy. Now, you didn't bring about that destruction in your competitor. Your competitor gets wiped out, and is over-levered and goes bankrupt and has to sell you assets in a fire sale environment. You just took advantage of the conditions that were in place, right? Because you were in a place like Buffett with a lot of cash at the bottom of the cycle when everybody's freaked out and nobody wants to buy assets to be able to buy those assets. Yeah. So maybe it's not victimization, right? Maybe that's not a fair way of saying it. Sometimes it probably feels like that. But the reality is anybody who has to dump assets at low prices, at the end of a cycle or at the bottom of the cycle, probably made mistakes that were avoidable.
Yeah. Well, 100%. I love the analogy to poker because it's effectively strategic exploitation. If you don't embrace that strategy at the poker table, you're toast, right? Like, wait until you're in position, wait until the stack is proper to the cards dealt. Then, you can be very patient, right? You're folding a lot of hands over a lot of time, but then when the time is right, you go super aggressive. And that, I played just a little bit of poker recreationally. It's like, that's the optimal strategy. It's tight, but aggressive. So you're tight all the time, but then when the time is right, you're extremely aggressive. And it maps directly to investing.
I would say that's right, with a little twist in that as poker has evolved, there's more of an awareness that actually positioning and situational awareness are very important, right? So it's not just, do you have aces or kings, these sort of highly valued hands, is do you have them on the button, or do you have them in late position, or do you have them in a situation where you get to play heads up against a significantly weaker player, right? Or in a portion of the tournament where that player is understacked and likely to be afraid of getting wiped out just before the money bubble, right? And so it's not just the values of the businesses you own, it's the situations, right? There's other components to it. There's obviously opportunities to switch gears based on the way the other people are playing. And that's a very Austrian, sort of way of thinking too, because at its fundamental level, the Austrians looked at how people actually behave in the real economy. They're less interested in, here, let's theorize about like how people might behave. They're actually interested in how people actually behave. And they're aware that people behave in completely unpredictable ways, but particularly at the individual level. Individuals behave in different ways for all kinds of different reasons, but collectively the markets find homeostasis over time if left alone to do their own thing, right? Individual actors, individual entrepreneurs acting independently, making independent decisions, ultimately get to the right place, right? And create healthy functioning markets. And this belief that you see, particularly around crisis moments, like you saw this in 2008, you saw this during the early stages of the pandemic, where people say, well, we can't just let this market self-correct and function. We have to stop people from going hungry. We have to stop people from getting foreclosed on, and we have to stop the auto industry from going bankrupt. And the Austrians would say that's fundamentally wrong, right? Like you're actually creating systematically a more fragile market, a more fragile economy by stopping that natural structure. And Spitznagel does a really interesting thing. He connects that to the forest. And forest management and the Yellowstone fire of 1988. And we've seen terrible fires in California over the last couple of decades. I actually left California in 2017, not because of the fires previously, but I was in California during some of the worst fire periods. I think like 2004 was one of them. And what you saw was that forest management, this idea that, you basically have to let these natural small fires happen is what makes the forest robust over time. Right. And the same thing with economies, right? If you constantly intervene in them, they become more brittle, and they're actually subject to larger, periods of stress in the future. Where there even worse things happen in the economy. Because of that intervention. So I know I'm covering a lot of ground here and crossing over across.
I love the crossover, and then it's the Talebian synopsis on that is delayed and suppressed volatility through human intervention just delays and exacerbates volatility. It's like you can't escape it. You're actually just going to make it worse, kicking the can down the road. And I mean, that's what central banking is doing in a nutshell, right? We're trying to paper over all these economic errors versus letting the market actually wash them out, let the capital be reallocated to its highest and best uses. And the analogy in the forest is interesting because when you do that, the fires can actually become so big and so hot that the conflagration burns away the topsoil, and then nothing can grow for decades. So it's like, it's a different nature of destruction too. It's a total destruction that comes in the wake of it, which is super fucking scary if you consider what we're at now. Like, we're at the tail end of this 108 or 9 year experiment with global fiat currency expansion. Like, how does this thing end? It's going to be, in theory, a catastrophic fire.
Yeah, absolutely. And, it's something that I think most people, particularly people from the kind of Keynesian tradition, they just don't want to believe that. They want to believe that there's these animal spirits, right? That there's these sort of magical properties of markets that cause, that cause these downturns, these recessions, and that we're Superman and we must do what we can to prevent them. Yeah. Right. Without recognizing that they're natural parts of any system, and healthy systems require, and it goes back to the cyberkinetics component, which is this feedback loops. These negative feedback loops are actually healthy. And these market cycles like we're seeing now that are artificially elongated by the Fed are actually not healthy because they incentivize risk-taking behavior. They incentivize momentum trading and investing and other things that actually don't drive real long-term capital formation. They're not actually making us wealthier. They're making us seem like we're wealthier.
Yeah.
And it doesn't work in the long run.
No,
It just
yeah.
doesn't work.
It's illusory, right? And especially I'm always astonished when I just reflect on the nature of fiat currency, how effective the illusion has been. It's like just by printing, diminishing the unit of economic value, money, we were able to twist people's perception. Like, oh, well, my house is going up, my stocks are going up, so everything must be fine. And it's just a first order deception. Like clearly you're getting robbed via inflation. But yet it's it's still working. People still think inflation's good and normal. And we're here. Where are we at now in the US? 40, 50 million unemployed, or they've left the workforce, sort of the term for that, labor force.
Leavers. Yeah.
Yeah. But the stock market's at all-time highs, or was at all-time highs. I know it's come down since, but how can people reconcile that in their minds? It doesn't make sense.
I think from a self-serving standpoint, a lot of it is that the people, the most powerful people in the economy, the wealthiest people in the economy are actually benefiting from money printing, right? And because if you look at the chart since 1971, right, of wages versus capital, it's very clear that the prosperity of the wealthiest people in the economy has continued unabated. Mm-hmm. So there is no problem really for those people. The people who sit on the central bank board, the CEOs, the hedge fund managers, why should they complain about a system that's actually, at least for now, working for them? I think the challenge is when the wealth inequality gets so severe at some point that it begins to actually affect their quality of life. When people are jumping over the gates of your gated community, I don't care if you're a billionaire, you're not going to be happy about that.
Exactly.
Right. And there's also constraints between the physical world, right, and this sort of fake world of fiat monetary policy, which popped up a little bit during the pandemic here with these supply chains that have sort of broken down, where again, you could be a billionaire, but you may not be able to buy toilet paper. Mm-hmm. And so it brings in this sort of like front and center. It reminds the wealthy class, frankly, people like me, right? I'm not going to make any, illusions about that, right? Like I've been blessed and lucky over the last 20 years to build a lot of capital through building businesses. Now I'm aware that the fiat system played a role in that, right? Like my ability to raise cheap capital got easier, by the way, from 2009 when I raised my first seed round of capital till now. Now you can raise a $20 million seed round with very little effort. Back then it was pulling teeth in 6 months to raise $1 million in seed capital. So that's the pernicious impact of lower and lower interest rates and an easier and easier money environment. But in spite of all those benefits, like I still see over the long run that if the entire fiat superstructure collapses, it doesn't matter how many fiat shekels you have in your bank account, how many planes or boats or houses, whatever you have, your kids are not going to have a safe place to live. They're not going to be able to have the same experience we had in the past. And so at some point, if the system breaks down, it doesn't matter how well you did at playing a game that was fundamentally broken. And I think there are more and more people, even amongst sort of the moneyed elite class, that understand that.
Yeah. No, that's a great point. It's back to the forest analogy, right? That when the fire does come, it just devastates everything. You've delayed volatility, but you've exacerbated it to the point of destroying the roundaboutness of the production structure such that aggregate wealth is declining. So you're like the money is essentially just a call option on all that stuff. If all of a sudden less stuff is being produced, more capital is being consumed, then what does it matter?
It's just capital consumption.
Yeah.
Right. If people believe that money is going to be cheap forever and the hurdle rate for a new investment is effectively zero, then you could spray capital around on anything. Like going to the store and buying, marshmallows and Cheetos makes sense. Buying a new airplane makes sense. Right. Investing in startups that have no chance of succeeding makes sense potentially, because the alternative is, you own a melting ice cube.
Right.
This artificially low interest rates, artificially low cost of capital actually drives the consumption of long-term, more sophisticated capital structures and drives it into the here and now. And that fundamentally just doesn't make sense in the long run. It actually leads to a declining standard of living eventually over time. Yeah,
it's decivilizing even, right? Ultimately, civilization is just how much capital have we accumulated? And if you start consuming that, you're drawing down the capital stock. You're actually decivilizing the world.
You're also dehumanizing individuals, right? Because before low interest rates and before the fiat currencies, before the dollar was a reserve currency, you used to have to pay wages in your own local area that actually reflected both value created and the actual cost of living, what an employee actually needed in order to live there. Now you're complete disconnect between the fundamental reality of what value the employee actually creates, right, and what they actually have to spend in order to live in that area, and the business itself, right. So what you see is entrepreneurs just outsourcing big chunks of their production to completely disparate areas that have the lowest cost employees, whether that's good for society or not. And it dehumanizes people in these actual local areas, right, over time, because it's incentivizing behaviors that I don't think necessarily people would take on their own without that monetary manipulation.
Absolutely. Hey, everybody. As you've no doubt learned by watching this show, Bitcoin is the single most important asset you can own in the 21st century. And one of the most important companies in Bitcoin today is NYDIG. NYDIG's mission is to get Bitcoin into the hands of as many people as possible. One of the ways they are accomplishing this mission is by empowering banks and financial technology companies to offer their own Bitcoin products and services. As a true game changer in the industry, NYDIG is safely unlocking the power of Bitcoin for forward-thinking individuals and institutions alike. Led by Robbie Gutman, Yin Zhao, and Ross Stevens, NYDIG has absolutely exploded onto the Bitcoin scene recently and has quickly become a leader in this space. So, whether you are a professional investor looking for asset management services, or a company looking to white label your own Bitcoin product or service, consider NYDIG your single source solution for everything Bitcoin. Yeah, so the author, he's tying together a lot of ancient wisdom, let's say, which we'll start to unpack here in a minute, to the art of economics, really. And as he writes, the art of economics consists in looking not merely at the immediate, but at the longer effects of any act or policy. What calls to mind for me here is Economics in One Lesson, the book by Hazlitt. He always talks about the seen and the unseen. And as we were describing earlier, people are so focused on the seen in this fiat currency complex, like, oh, my house value is going up, my stocks are going up, everything is fine, but not seeing the unseen, which is this, I guess is it a regressive tax on the populace via inflation, plus you're, sparking populism in the long run. And, all these things we talked about that can be ultimately destructive to the roundaboutness of the production structure. So yeah, there's an art here. There's a real art of actually training yourself to be, I guess, perceptive of the unseen consequences of action versus the first order consequences of action.
Yeah, that's right. And it's related to, the intertemporal moments in the future, right? It's related to, you can experience something right now, but it's no less important than the thing you experience in 2 years. It's also related to this kind of Austrian, tradition of asking why, right? So a lot of times you can get to the same kind of belief, like, hey, this is what happens when you print money. But a lot of the other traditions just stop with here, this is what happens. They don't ask the next question of like, why did it happen? Right. And so I would say all of those kind of things are linked together in the Austrian tradition. Yeah,
definitely. The idea of Austrians asking why, it really puts the emphasis on the philosophical implications too. It's Keynesianism just doesn't, there's not a depth of thought there. They're literally just trying to really measure. It's applying this empirical framework to a non-empirical reality. Like the Austrians make this great point that there are no constants in human action. So you can't assign these formulas. Like we know water freezes at 0 degrees centigrade. There's no comparative fixed relationship in the sphere of human action. Like everyone's just subjectively acting all the time. So yeah, the axiom that Mises starts with is man must act. And He writes here that, what stood out was the role of time in Mises' worldview. Time permeated everything. All action was a temporal succession of events, always of steps and fractions of time, the aim of which was the removal of future uneasiness. It's a totally different view on the world. And he ties that, it does get interesting where he starts tying this into, the nature of forestry and later Marshall strategy, I guess, in Clausewitz, right?
Yeah. So he links, it's very interesting. He links like ancient Chinese philosophy to Napoleonic era military strategy.
Yeah.
And this great strategist, Karl von Clausewitz, who came about in the late 18th century, like the 1780s, I think he was born. Yeah. He was a Prussian general. He actually achieved general status. He started as a cadet, went to general status over time. He was a military scholar and writer. He hated Napoleon in a lot of ways, right? Because Napoleon was his adversary. But at the same time, he admired him and liked to write about him. And Napoleon was actually the centerpiece of his great work. Von Krieg, I think, is the name. And so, his view is that Napoleon was decisive, and the reason why he was winning in a lot of ways because timing was everything. And he was very decisive and good with timing. Clausewitz was actually captured by French forces in 1806, believe it or not, and survived that experience. He was in jail for 2 years, in which he spent a lot of time thinking about why the Prussians were losing to Napoleon in a lot of their battles. Clausewitz was heavily influenced by German philosophers like Immanuel Kant. He was criticized roundly by some of the British military philosophers like Hart, who said, blood is the price of victory, great battles, great results, total war approach is basically wrong, right? So he criticized Clausewitz's strategy. But I think at a high level, the thing that really stuck and the reason why Spitznagel brought it up is this concept of zeal, which is the purpose of a battle is not achieving the end state, right? But it's rather of achieving the means to achieve the end state, which is called Zweck, which is winning the war and ultimately achieving peace. He's also focused on attacking the opponent's center of gravity. His idea was if you attack the center of gravity of the opponent, you can cut short the war by cutting off, the important pieces of the other side's infrastructure, right? So if you attack the supply depot, or if you attack particular parts of the opponent's forces, you can actually cut the war short. And then one of the last things that he brings up is just this idea of attacking in waves versus attacking all at once. So he uses the story of two sides have 1,000 troops. One side decides to throw all of their troops into war. The other side only initially deploys a regiment of, say, 200 of 1,000. So, or 500 of the 1,000 actually. And so what happens is in the initial skirmish, both sides lose 200, but the one side has all of their troops engaged. And so they're already tired, they're already engaged, and they're not paying attention when the other side, from a position of strength, is able to attack using the remaining 500 troops. And in effect, the way Spitznagel describes it is that Napoleon lost by essentially doing this total war straight down the middle, like using all of your troops to attack aggressively, using kind of a Li strategy from the Chinese philosophy concepts, as opposed to the Sure or Shi strategy. And whereas the Prussians had learned to attack more in waves, and they were able to actually win some of the great battles against Napoleon using that strategy. And obviously they ultimately banished Napoleon to the island of Elba.
Yeah, interesting. Let me a couple of these terms, are you comfortable defining them? Because I know I don't recall exactly what they are, but Zweck was this potential energy, which I guess is analogous to capital, something like that. And you mentioned G.
Zweck's the final end result, the ultimate victory,
right? Which
in warfare, would be the actual peace, right? Itself. That's the ultimate victory. And you use the energy, which is the Mittel, right? Which is the means, right? The zeal is that positional advantage. It's that intermediate step where you look for that positional advantage, which ultimately leads to the Zweck. So the Zweck is the end state. That's the final state when you've won. And the same thing exists in business too, right? Where the whole point of the Austrian economic tradition is to accumulate the means of production so that you can achieve the final victory of sorts. And he kind of uses different words, right? So Umweg, I guess, is the word in the Austrian transition that actually connects with the zeal in the kind of Germanic language, the German philosophy, right? The Clausewitzian terminology, if you can indulge me and allow me to say that on your podcast.
Of course. So it's means, ends, position.
Yeah, it's the strategic position. It's essentially like the process in which it's the process, right? It's the process in which you achieve the strategic positional advantage, which leads inevitably to the final result. Gotcha.
And then the last one was the zeal, which is the morale or the spirit, I guess.
The Zweck. The Zweck is the final result. It's zeal, sort of from a process. Zeal, Mattel, Zweck, right?
Okay. Zeal. Okay. Zeal. Okay. Yeah. So not zeal as we understand it. This is what language are these terms from? I forgot.
I think it's a Germanic.
It's Germanic. Yeah.
Like in origin.
Yeah. I remember reading this book and I had a hard time. Like I kept having to look back and because he'll drop these terms a lot. And I kept having to look back to see which was which.
I don't know if he's using all of these terms to help us or if he's doing it to show his tactile understanding of the material.
It's like a soft flex.
It's been 20 years since I was a student. I was a history major and it feels a little pedantic. It feels a little professorial, but to really feel, because some of these, one reason why you might do this though, is that some of these terms actually only exist with the exact kind of meaning and definition in that original language. So you could attempt to describe them using other languages, but they don't necessarily mean the same thing. And one example is this kind of this SHI, right? The sure, if you use the Chinese pronunciation, which means effectively the same thing as zeal, which means effectively the same thing as Umweg. There are three different languages. The Umweg is actually considered to be more of a kind of lower end word. It's less showy and fancy and less magnificent in that tradition, but it effectively means the same thing as those other words. But again, things are often lost in translation.
Yeah. There's not, especially from, Germanic language to English, there's oftentimes words they have that we just don't have a word for, that you end up, we spend 15 words trying to describe their one word, something like that.
And we've got to accept the author at face value here, that like he really is making valid connections. It feels right. So I want to believe it. There are probably some things that other scholars might say are a stretch. But I generally agree that there's a philosophical connection between ancient Chinese philosophy, right, and the military strategy of Clausewitz and the Austrian tradition. I generally agree with that connection.
Yeah, seems like he's using consilience of these multiple viewpoints that all point toward a deeper strategic reality of some kind. But there's different language, different vernacular in each school of thought, but they all have sort of similar dynamics. And yeah, it's really, really interesting. And it lends a lot of credence to what he's saying too. It's like, clearly this is something almost like a natural law type thing. Like this was discovered by multiple cultures over time. This isn't something a group of people just made up by Fiat. Like this is discovered, I guess is the best way to put it. Something that, a market process unsurfaced.
And that idea of a natural law or fundamental truth pervades the Austrian tradition. Like that's fundamentally what they were looking for, is what are the fundamental truths about the way money works, the way economies work, right? That can be encapsulated in some of these belief systems that we have. And then how can that direct capital production, capital formation, entrepreneurship, and investing in the real economy? And I see the linkage when Spitznagel writes the book this way, although there are probably some parts where anti-Austrian folks would be able to pick holes in some of it and say, look, that's a bit of a stretch there.
Yeah, I agreed. I actually tweeted this out today that Ludwig von Mises is the most underappreciated philosopher in history changed my mind. And I believe that because he's not even, first of all, not many people know who he is at all. If they do know who he is, he's just considered to be this figurehead of Austrian economics. But when you actually read a book like Human Action, the book's like half philosophy. I mean, he does a very rigorous job on the economic side of things, but he's also giving kind of the philosophical or ethical case for Austrian economics as well. I'll read, this is kind of a long excerpt, but I think he's just sort of tying some of this together, and he's tying it back to Clip as well. This is, acting was to relieve our insatiable impatience and the pains caused by waiting. And overcoming this natural urge was the necessary key to productivity, roundabout production, the harvesting of the physically more abundant fruits of production processes, consuming more time, and thus the significant role played by taking account of waiting time. Mises rightfully credited this central notion of the roundabout to his predecessor, the great Austrian economist, Eugen von Baum-Bolwerk, hope we're pronouncing his name right, the subject of chapter 5. Degrees of impatience, what the Austrians call time preference, the singular source in Mises' view of interest rates, in waiting and foregoing immediate profits or consumption, and even bleeding capital, such as through costly capital expenditures, was a logical part of our humanness. Indeed, part of that humanness, which we had to overcome to do certain propitious things which cumulatively amounted to the very progress of civilization. This was Clip's paradox writ large on the grandest scale, formalized and temporalized in the Austrian economic language. So I think that excerpt gives you a little bit of a taste of how this guy writes too. I mean, it's dense, and he's got all these, what are the M hyphen inserts, where he's going into one thought and then he inserts one other big thought and then he goes back to the original thought. Mm-hmm. So it's a very dense book, which I enjoy reading, but it can be painful for a lot of people as well.
Yeah. They call it the magnus opus of the Austrian tradition, this Human Action. I enjoyed reading about him and his life too. I mean, the fact that he was able to escape from the Nazis and find a new home in the U.S. and connect with some of the Americans that continued on the Austrian tradition. And actually, Spitznagel says if von Mises had not escaped Europe, it's unlikely we would even be talking about the Austrian tradition at all, because he was able to bring those ideas forward, and people like Hayek and Murray Rothbard continued that. Mm-hmm. But the other thing that Spitznagel connects it to, which is kind of interesting, is the neurological development of the brain, of the hippocampus and the frontal lobe, and people's ability to impulse control and do long-term planning and understand incentives and connect short-term to long-term memory. Right? These are all things that you need to have in order to trade off something today for something bigger or better in the future, mm-hmm. which is fundamentally like what a lot of this work around time preferences is all about, right? So understanding, the impatience and the pains of waiting, right? And being able to resist those urges, which he gives the story of this Phineas Gage character who was working on the railroads and gets basically a spike through the brain, mm-hmm. and loses the capacity to do long-term planning and show up on time for work. And he's alive, right? He surprisingly lives, even though there's a hole essentially in his head, but he's never the same again. And to some degree, Austrian thinking is like a higher order brain, mm-hmm. Type of process, right? Because you're resisting these base level urges to take more now in order to take more in the future. Now, obviously, he's not talking about just long-term, right? Which he kind of considers to be a trope, of long-term investing. Mm-hmm. What he's talking about is this intertemporal waiting for when the conditions are right, so that you can actually take advantage of things in the economy. So it's not with a telescope that you look to the future, right? It's enjoying every single moment, being aware of every single moment, but being aware that in 2 years and 2 months, the market may sell off dramatically, allowing you to take advantage of mm-hmm. opportunity. The other thing that von Mises talks about is like the natural rate of interest, mm-hmm. this concept that there's a there should be a real rate of interest rate, and that rate should revert based on natural organic business cycles, right? And based on the needs of real consumers. And I think that's an important concept, because if you don't believe that's true, then you might be willing to accept a Keynesian, type of explanation that it's okay to choose interest rates and to manipulate those interest rates based on our needs. I think, the work of von Mises and others would suggest that that's artificial, right? And that creates imbalances that ultimately have to revert to a true final state of rest in the market. And this idea of a final state of rest it pervades von Mises' work too, where this part of the market where the buys and sells are all balanced, and we've created this kind of perfect stasis.
The evenly rotating economy, I think he calls it.
Right. And the same thing exists as it relates to this parable, the parable of Nibelungen and Johann and Gunther and Siegfried, where, in a state of rest, right, the cost of capital is exactly equal to the rate of return of any entrepreneurial activity. And so the economy is essentially in a permanent state of rest. Now, obviously that's only the realm of history books and textbooks and whatnot. The reality of entrepreneurial activities in the economy is much more messy over time.
Yeah. He uses those imaginary constructions like the evenly rotating economy just to diffuse some fallacies about economics. Because in that case too, where in the case of the evenly rotating economy, the demand for cash goes to zero, because you can perfectly map all of your inflows and outflows such that you never need money, right? Money is the optionality against uncertainty. You don't know what you're going to need it for, but in that environment of perfect information, you don't need optionality. So it's interesting the way he does that. And then two, on the natural interest rate, that's such an important point, because again, we're conditioned to think that the interest rate is some policy tool of government, but it's not at all what it is. Again, it's a natural market phenomenon, and it has to do with our time preference, right? It's ultimately, at what rate do I prefer receiving capital now versus later? The more I want it now, the higher price I will charge you effectively, which is also reflected in the price of money. But this is applicable to all forms of capital, really, as he makes the point. And that's such an interesting little known point, because if we did have this natural, we know as free market capitalists, we want the market to set prices on all things. You have a pricing czar or some form of government intervention setting pricing. You're only going to create surpluses or shortages, right? You're going to distort the market. Yet we tolerate it in the market for money, like it's the norm, which is the most important market in the world, clearly. And it gets a little more interesting too when you start considering its relationship to civilization and the moral standard itself. It's like when you're tweaking that interest rate, you're creating these distortions in the marketplace. And that's why I think, so many people have this, they're plagued by this short-termism, because, we've narrowed our intertemporal sight, if you will, to be very minimal. And then people, they're incentivized to take on more leverage. And when the tide goes out, more people are caught swimming naked.
And it's because the natural interest rate, when it falls, it should be a reflection of real savings.
Yes.
It should be a reflection of falling time preferences throughout the economy, where savers are choosing, using their free choice in a free market economy to save more of their capital for the future, right? When you artificially manipulate that, right, you completely change the incentives, you create perverse incentives. And so it's very related to this concept of money too, because the Austrians believe money must originate more organically as a useful commodity, right? They don't believe that money is completely neutral, right? So Austrians believe money always takes a side in a sense. And so if you create money, right, as a fiat entity, as a government, you are choosing sides, because some parties over others are going to benefit from your manipulation. So in the same way that we would prefer a natural organic interest rate that actually reflects free market actors in a free economy, we would also prefer a sort of a naturally emerging free market money. Now, that wasn't really that easy or possible before Bitcoin. But in a lot of ways, Bitcoin is the natural manifestation of the Austrian desire to have this naturally emerging commodity as a tool. And as you're reading books like this, I find this constantly recently. When I read a book like the Dao of Capital by Spitznagel, I keep waiting for the moment where he talks about Bitcoin. And I always chuckle a little bit because I realize how early it was. He wrote this in 2013, and very few people understood Bitcoin then, let alone today. But Bitcoin actually does solve for some of the issues that Spitznagel brings up in the book.
Yeah, absolutely. And that the Mises regression theorem, which was put forth by Mises, he said that something had to emerge as a marketable commodity before it could become money later. People have tried to use this to refute Bitcoin. They're like, oh, well, Bitcoin was never a marketable commodity before it was money. But I think, I don't know, there's a couple of ways to look at that. One is the things that comprise Bitcoin were clearly useful before Bitcoin, right? Like software and microchips and ledgers and all of these tools, very basic tools in a lot of ways. But it also, the theoretical point just doesn't hold up to practice, because you're like, okay, you're trying to refute something. You're trying to refute Bitcoin theoretically, but it's like, just look what is happening in practice. Like Bitcoin has a monetary premium. It's pure monetary premium. In fact, it trades 24/7. It's a $1 trillion asset. So you're trying to refute practice with theory, which I think is just kind of self-defeating. And then on the point of monetary neutrality, I mean, Bitcoin's so important in that way, because like whatever we monetize, we end up making more of. We just create an incentive to make more of that thing. Gold's a great example. 10, maybe 20% of its market cap is industrial use. The other 80% is store value. So we're like mining and producing a lot of gold, but really, someone joked this, that we pull it out of one hole in the ground to go and stick it in another hole in the ground, beneath a central bank, and we call it money. But it's the proof of work component to gold that made it useful money among its other properties. But with Bitcoin, we get something unique in that we've effectively monetized energy, right? Directly monetized energy. So what does that mean for the world? We're going to produce a lot more energy and a lot more abundantly and more cheaply. So, I think the long run outcome of this game, the Bitcoin game specifically, is that, energy is the number one input to any economic activity. It's just going to be to increase aggregate wealth through the monetization of energy alone, not to mention all the disintermediation it accomplishes, which unlocks even more wealth creation.
Yeah, there's a lot there. I want to add just one idea, which is this idea that value is subjective, right? And you go back even further in the Austrian tradition to Karl Menger, like sort of the founder, talked a lot about marginal utility, right? And utility is there because people use things in order to achieve some sort of an end, right? So based on their real world actions. And so you can argue all you want about whether something has value or not, but if people find that it has utility, they're able to use it to achieve some end, then it has value, right? Right. And I think that's important to say.
Absolutely. Can't argue with free market action, right? If people want it and they're willing to expend resources for it, then so be it. Spitznagel uses this term intertemporal. We've been throwing it around a little bit here. How do we define that, and what does that actually mean for people in the real world?
So I think a lot of, particularly from the investing side, people think of things as either being kind of short term, like the here and now, or long term. And there's sort of no intermediate level in there, right? And so time is a key variable in everything that these guys talk about on the Austrian side. But it's the intertemporal component is moving from the immediate to the intermediate, right? And expanding your depth of field so you can see a succession of future times. And he talks about like connecting them almost like a video reel, right? Or as a succession of photographs in a movie versus a snapshot, and seeing the long span of forward movement. So instead of just seeing here and now and then imagining yourself at 75 sitting in a rocking chair, being able to imagine all of the moments as snapshots between now and 75, almost individually, right? So being able to expand your frame of reference beyond the here and now and the far future. So instead of using just a telescope, right, to see the future, or a microscope to see today, being able to see the entire succession of future movement as sort of a movie. That's the way I conceptualize it.
Yeah, that's a great point. So increasing both your depth of field across time, but also viewing it in a more dynamic way. You're actually looking at the sequence of events leading to these individual snapshots versus just the static snapshots themselves.
Correct. Where each snapshot leads to the next in a chain of events with connections, right? I think that's an important part of capital formation. It's also an important part of investing intelligently. So,
yeah. You could also maybe say it's sort of like a blockchain-like perception, or not just conceiving of future balance sheet snapshots. You're actually considering the P&L bridges between those points along the way.
Yeah, I mean, look, it's absolutely connected because each block header has the previous block hash appended to it. It's literally why it's called a blockchain, right? Every node knows that it's the next block based on the what's in that block header.
Right. Yeah, he really needs to write a sequel to this book with Bitcoin included. And maybe if he denominated these investment strategies in Bitcoin too, that could be interesting.
He probably should have Bitcoin in his main fund, but remember, he's buddies with Taleb, so that may be a challenge philosophically.
Right. That's funny. Yeah, that still makes no sense to me. I mean, I'm not a mathematician, but I've heard several mathematicians speak out against Taleb's black paper math. So it seems like he's taken some kind of personal beef against Bitcoin.
Yeah, I think that's exactly what it is. Look, pride and ego are they can be powerful in some contexts, but they could also be your downfall.
Yeah, indeed. So should we jump into the practical application of this? Like, how does he encode all of this wisdom into these investment strategies, which I think he calls Austrian Investing 1 and 2?
Yeah, so he breaks it down a couple different ways. He starts with this ratio, this Faustman ratio, which he uses initially. It was initially designed to like value forest land and decide, when to actually conduct forestry versus when to just sit on the land or even sell the land. And he evolves that into something that's called the Tobin's equity Q ratio. He changes it to the Misesian stationarity index, which is basically just U.S. corporate equity divided by corporate net worth, right? So it's like a measurement of effectively like how overvalued equities might be relative to their kind of underlying net worth. So when the value is over 1, monetary intervention, is probably causing inflation and the titles to capital. Obviously, higher starting values in this ratio lead to lower expected returns. All the work on equity markets shows that. And so he basically says, listen, when this index is over 1, you should consider not being in the market at all. Like that would be the simplest way to practice Austrian economics. So like, for example, right now, when the index is closer to 1.7, you should probably not be deploying new capital in equity markets. You may even consider selling, right? That would be what a hardcore Austrian would do. Now, most professional investors are not going to do that because they get paid to manage assets and make decisions, and they get measured in monthly and quarterly increments. It's very hard to have the discipline and patience to do that. So he says, look, here's an alternative way of thinking about it. One simple, naive way to invest like an Austrian is to put 99.5% of the portfolio in the S&P 500 and put the remaining 0.5% in long dated, out of the money, not long dated, sorry, short dated, 2-month, out of the money, about 30% out of the money S&P puts, such that if the market were to sell off suddenly, because basically anytime markets are at this high Misesian stationarity index ratio, there's a good chance they will sell off. And he makes the delineation between black swans, which are sort of unforeseen but remote events and events that he considers to be foreseen. So like a stock market crash, which should happen every decade or so historically, right? And a pretty regular interval. And it's much more likely to happen historically based on the, the underlying valuation of the market at that time. So he uses this index to tell you whether or not the market's overvalued or undervalued. And then he says, look, when the market's overvalued, you want to be buying puts on the S&P 500 2 months out. Every month you roll the position forward. So you essentially liquidate the puts as you get to the end of the month, and you roll them again 2 months out. And then the second part of Austrian is what do you do when you actually have a downturn in the economy? So like when the puts actually pay off, which he did really well in 2008, 2009. And again, during the pandemic, because those puts put off, is he takes that capital while the titles to capital are temporarily low, right? Because there's a sell-off, there's a market rout, people are scared, they're liquidating assets. And he turns around and buys what he calls Siegfrieds, which are essentially just high return on invested capital companies. So companies where the returns on the capital invested are unusually high. And he, over time, believes that process will yield essentially 2 points better than just a pure equity approach over long periods of time. The challenge is that for any shorter period of time, 3, 5, 7 years, right, that actual strategy may underperform. It's very hard for professional investors to run it. The other thought that came to me as I was reading it again for the second time is that there seems to be some structural changes in the market, particularly in the last 5 to 10 years, as it relates to technology and as it relates to kind of the growth in the digital world, where you're seeing an increasing share of companies' balance sheets denominated in IP, right? Where IP heavy companies trade at higher valuations, they generally show higher returns over time. And this ratio that Spitznagel is using doesn't really capture that very well. I think it also underestimates the growth in MMT and modern monetary theory and the extent at which politicians and Federal Reserve personnel are willing to push interest rates down far longer and further than anyone ever perceived was possible before. And so that leads to situations where, for probably a decade or more, it looked like this Austrian philosophy would suddenly work. But what actually happened is that markets from 2013 till now essentially went almost straight up, with the exception of a demand shock last year caused by the initial response to the pandemic. So I'm a huge fan of the philosophies that Spitznagel talks about in the book, but I wonder to some extent whether certain components of it have broken down a little bit, right, in a structural way, not just a cyclical way. Like some people would say, "Hey, you're just saying that things are different this time," and I'm not really saying that. What I'm saying is there are fundamental structural things that are changing in the economy. I mean, 20 years ago, if you told me that 5 technology companies would be the biggest companies in the world, I wouldn't have believed you. Yeah, right. I would have thought ExxonMobil and Walmart would still be some of the biggest companies, but Google, Facebook, Apple, Amazon, et cetera. These are real businesses with real earnings power, real products that everybody uses. And so the idea that you can measure their value entirely using this sort of Misesian stationary index, which just looks at their corporate net worth, I'm not sure that's capturing all the value creation that's actually happened in the economy.
That's really interesting. Yeah. So this is somewhat of a barbell strategy, right? You're just buying a lot of low risk S&P 500 index, but then also some very high risk out of the money short-term puts. Specifically when this, was it the Mises stationarity index, I think, is above a certain threshold. You're basically
above one.
Yep. You're betting on regression to the mean or even past the mean. So that's really interesting, but it is a very low time preference investment strategy because this thing will bleed capital for a decade,
every
right?
Month.
Yeah.
Every single month it bleeds until that market shock comes, in which point you clean up and you look like a genius, and the journalists write articles saying you're so smart. Yeah. They don't write articles on the months where you just lose money. Right. And the years you just lose money relative to the S&P 500.
Yeah. And it's massive too. I think in Q1 2020, it returned like over 4,000%, something staggering, right?
Right.
Yeah.
Right. And it speaks to this intertemporal waiting and patience of recognizing that it doesn't matter whether you lose 1% a month for 7 years if you make 4,000%. Right. In 1 month, that more than makes up for all of those losing months. Most people do not have the fortitude, right, or the patience to take the small cuts and the pain all the way in order to get to that kind of final spot down the line. But that goes to roundabout strategic positional advantage. It's all of the themes in the book, encapsulated in this ultimate strategy.
Yeah, no, excellent. But you have this, I guess, a counter argument to some extent that structural or fundamental changes in the global economy, largely related to the digital age and or government intervention, could perhaps drive this ratio higher, where maybe this thing, the economy could run hotter for longer periods of time before correcting to the norm. Is that what you're thinking?
It's not necessarily that they can run hotter. It's more that valuations could be driven more in a sustainable long-term way by technology and IP in a way that would cause a sort of naive, ratio, like the stationarity index, which is really like more of a like price to book.
Yeah.
Right. Like a classic value investor is looking at the book value of the assets. Like for many years, there was a line item in P&Ls that said property, plant, and equipment. Right. That seems pretty outdated nowadays. I mean, companies not only do they not own their own buildings, they barely want their employees to come to work in 2022. Right. Next year, like a lot of companies are going to be going fully remote. Yeah. A lot of the value, the flywheel that makes an Apple or a Google or a Square or Netflix successful is not encapsulated cleanly in corporate net worth in the same way that it used to be. And so it's not that like, it's not that the economy needs to run hot. It's simply that the ratio you're using, the metric you're using to decide when and how to run the strategy may actually not capture, when the market's really overvalued. Because that's really what you're trying to do with that index. You're trying to swing bigger and swing harder when the conditions are best set up, when the odds are essentially in your advantage. The same thing you would do, like when poker, you push all in when you think you have 80% or better, when you think you have aces versus a lower pocket pair, right? It's that sort of way of thinking. And if your ratio is broken because of structural changes, then you may believe earlier in the cycle then it's actually a good time. You may believe it's actually a good time to swing bigger.
So perhaps summing that up to the network effects being priced in on the market could justify a higher ratio.
I think that maybe you could flip it around and say, maybe to make this make more sense for the next 3, 4, 5 decades, you would need to revise the ratio to account for other sources of sort of balance sheet value beyond just hard assets and corporate net worth, assets minus liabilities, right? Because so much of the value in the future is not going to be so cleanly encapsulated in traditional GAAP accounting.
Yeah, I'm thinking of a company like Facebook. If it's never been acquired, there's going to be no goodwill on the balance sheet. So it would have all of this kind of economic moat that's just not accounted for, right? Whatever makes Facebook. I'm calling it network effects. I mean, there's a lot of other things you could call it, I suppose. That's just not reflected on the balance sheet.
Yeah, the market cap should far exceed the balance sheet because a lot of the value is off balance sheet.
Yeah.
Right. Like your engagement with their platform is not on the balance sheet.
Right.
It should flow through over time into their, quarterly financials. But I think this idea of using equity tail hedging makes a lot of sense at the end of a market cycle. Like I think a lot more people could benefit from, say, owning out of the money puts, right? Like I was even thinking about adding it to my own portfolio over the last couple of years, but I've started to think of barbell investing a little bit differently from that, where I actually think Bitcoin should be a part of the barbell. So like my preferred retirement portfolio now is approximately 20% Bitcoin and about 80% traditional, similar to Spitznagel's, Siegfried's, these high ROI companies. But I'm thinking more about lower multiple, higher yielding value equities where a retired individual can achieve all the fiat cash flow that they need from the equity side, but they can achieve all of the long-term purchasing power increase they need from the Bitcoin side. And you don't need to use a lot of Bitcoin. I go up to 20%. Yeah. You can probably, historically, you could have made that 5 or 10% as your barbell and it would have done really well. But I think today, like 2021 with Bitcoin at 47,000 or whatever it is, I think up to 20% of the barbell can be Bitcoin. And that portfolio is going to exceed the returns of almost every traditional 60-40 portfolio and every sort of Morgan Stanley, Merrill Lynch portfolio that is built for retirees. And, you know, it's still early, right? For this way of thinking, like most people who are retired don't even think about adding Bitcoin to their portfolio. But I think owning Bitcoin is a way, it's like a reverse option, right? Like he's basically insuring against cataclysmic declines in asset prices, right? Mm-hmm. And then using that insurance, the returns on that insurance to accumulate more assets. Mm-hmm. Bitcoin is sort of flipping that around and saying, look, I don't need to own these derivative products. I can just own hard, sound money, and it will organically over 3, 5, 7 year periods accumulate additional purchasing power in a way that effectively does the same thing. You could sell it. You could sell some of your Bitcoin in 5 or 7 years and accumulate more traditional assets or mm-hmm. income producing assets to achieve a longer retirement. I think it's all about your time preference, right? In a sense, this Austrian economic tail hedging strategy that Spitznagel proposes actually in short periods has a sort of higher time preference, right? It's wanting to take advantage today of short-term routes in the market today. Whereas Bitcoin on a point-to-point basis actually takes advantage of long-term purchasing power increases. In any given month, we have no idea what Bitcoin's fiat pegged return will be. It could be negative. It could be substantially negative. But on a point-to-point basis, if you really understand Bitcoin, it actually ensures greater purchasing power over longer time frames. Mm-hmm. So effectively, maybe the best Austrian portfolio is a barbell that includes traditional value and high ROIC oriented equity, core Bitcoin and cold storage that's not levered, right? Not a derivative, just Bitcoin cold storage, and a small percentage of the portfolio in a tail hedging put strategy. I think that portfolio seems bulletproof to me if you look out 5 or 10 years, because you essentially win in almost any economic environment with that type of portfolio.
Let's spitball something here, because what if you had a strategy that was 99.5% Bitcoin, or call it 99% Bitcoin, 1% these short-term puts that you're rolling, 2-month puts you're rolling month to month. And then you get into a tail event, Bitcoin, whatever, say it's a March 2020 type event, Bitcoin draws down 50%, but the puts pay, right? Massively, whatever that is. And then you roll the put proceeds into Bitcoin that's in a drawdown. And so long as what I'm thinking here is if you really think far out and you're denominating yourself in Bitcoin, you're not so concerned about the dollar denominated returns, that might be a really potent strategy. Because now you're buying Bitcoin at a discount when these puts are paying, and you're taking a lot of territory on the network.
Are you talking about a direct hedge against the Bitcoin exposure using Bitcoin puts? Or are you talking about
no puts on the S&P? The same puts he's using, but just denominating the whole thing in Bitcoin. You're just treating Bitcoin as the safe end of the barbell versus the risk.
Yeah. So, I mean, there's a couple of potential issues, right? One is controlling for cash flows. Right. It's the same problem that insurance companies have long duration liabilities, right? But they have a need for some short-term ability to pay off. Like let's say a policyholder dies tomorrow. You need to have some liquidity to do that, but you also need to have assets performing at a high enough rate that you will be able to pay off future liabilities. And so if you do not need cash flow, then certainly a 99.5% Bitcoin, particularly if it's in cold storage, might make sense. I think most people do need cash flow, particularly retired individuals. So like you have to delineate between people who require cash flow and people that don't. I think, like the other issue is just the decreasing correlation between the S&P and Bitcoin over time. So if the S&P and Bitcoin were perfectly correlated, then that seems like a really good strategy. The challenge is that over time they shouldn't be correlated, in my view, and so you may not get the exact situation you want where S&P sells down, you collect the put returns, and you're able to roll it into Bitcoin at some artificially suppressed price because Bitcoin might actually go up.
Right? Yeah, I think I agree with the longer duration correlations breaking down, but it seems like in those major risk off events, the Bitcoin's still very much a risk on asset. Like a March 2020 style liquidity crisis, I would expect if that happened today, Bitcoin would draw down 50% probably.
That's been the recent history, right, of Bitcoin. But I don't think we should delude ourselves into believing that recent history will continue forever. And I wouldn't build a 20-year because I'm an ultra long duration investment thinker. So like I wouldn't build a 20 or 30-year strategy for my mother's retirement.
Right.
That includes hedging an asset that I don't actually think is related long term, even though in the short term it seems like a reasonable protection. But I think if you bought puts against your equity portfolio and then also use Bitcoin as part of your barbell, those three things together actually are really interesting. And you also solve my initial issue, which is how does my mother pay her fiat bills next month, which right now she's paying using some of the most boring dividend paying stocks in the world, soda companies and healthcare companies and energy pipelines. And these are core assets. They're not going away no matter how successful Bitcoin is. You're still going to need natural gas to bridge us to a cleaner energy future. Like you still need natural gas pipelines, right? People are still going to drink sodas. People are still going to need to go to a doctor, right? They're still going to need pharmaceuticals, whether you like that or not. And so my strategy is like, well, how do you win in all environments? Well, you own equities that are, when they get cheap and they provide high enough cash flow to justify the risk. You own Bitcoin because you know that fiat currencies eventually are going to go into decline, and they're going to print too much money and manipulate the economy, and it's ultimately going to drive the purchasing power of Bitcoin up over time. It's a virtual certainty. And if you want to hedge all of it with S&P puts, a small amount of S&P puts, and take that, as Clip would say, the small losses every single month for that big return, go for it. Even Spitznagel in the book, though, does advise people that look like most people are not sophisticated enough to actually use options intelligently. And so he says, don't run out and do what I say I'm doing. This is a highly sophisticated strategy. Most people don't even, I've seen this with my father-in-law and my mother recently, like they don't want to check their investment portfolio even every month. Right. So they're not going to want to go in, find the market price for their puts, and then acquire the next month out, roll the contract forward, figure out whether they're paying the right price, wait for their limit order to fill. Right. And then do all the calculations to make sure that all made sense. So. Yeah.
Agreed. It is tricky and complex. There's a huge learning curve, but it seems like some of this could be, put into an algorithm of some kind, especially if it's based on percentages, right? And you're just using indexes in Bitcoin. You just say, here are the allocations. Here's, I want to buy a 2-month put, roll it each month.
It should be an ETF, Robert. Honestly, there should be a Austrian, investment strategy ETF that just holds high ROIC companies in some sort of a proprietary designed index, right? That uses the overlay of valuation, not just because the highest ROIC companies, a lot of them, these technology companies are at least right now trading at very high valuation. So it's probably not necessarily a good idea to pile into those today with new capital, but then also runs the put strategy embedded within that fund. So the end owner of that ETF never has to touch the puts or the index itself. They just own the end result of that strategy. I could see that being interesting, and it is sort of a liquid alternative strategy, right? Which is a really hot topic over the last couple of decades. Which is, how do we take these alternative strategies, private equity, hedge funds, VC, et cetera, and turn them into a consumer, like an end consumer consumable product that's easy for somebody to buy in their brokerage account. So maybe that's something we should do. Maybe we should do the Breedlove Austrian ETF strategy.
I'm surprised Spitznagel has not done something like this.
I think part of it is that because he was the pioneer with Taleb of kind of doing this early tail risk hedging, and kind of even created the nomenclature around how it works. There's some alpha in just executing it privately yourself. Right. And if you turn it into a mass market product, you sort of commoditize your own edge.
Yeah.
Right. And so he's not a humanitarian. Like he doesn't make any qualms about that. He's a unabashed free market capitalist. And so he's maximizing his edge in the same way anybody would, you know, when they're still printing money. Right. Is why, when you're printing money, why commoditize your edge and turn it into a consumer product? So
yeah. Back to Klipp's paradox, right? If he did that, it would sort of be a self-defeating strategy, but he could make a ton of money in the short run. I'm just thinking of kind of the Barry Silbert move here where,
well, he already is making a ton of money. And so why would he want the additional scrutiny, the additional challenges of running a consumer facing product? When you run a private fund, as you know, you can raise money from very sophisticated people, right? They either understand or they don't, but they're not going to lock up their capital for 2, 3, 4, 5, 7 years unless they really understand the strategy. The problem with retail, as we're seeing with Cathie Wood, is even if you're fundamentally right about the direction of the world, clients always want to pull their capital right at the time of maximum advantage.
Yeah.
Right. So you run this retail Austrian ETF. Guess what's going to happen right before the puts are going to pay?
You start dealing with a high time premise.
They're going to be down. The fund's going to be down from $500 million to 42 million on the day the puts pay.
Yeah.
And so the actual real experience return of that end consumer user is much lower than the actual return of the fund itself, which is sort of doesn't care about money flows. It just executes.
That's a good point. It's you're better off running the low time preference strategy privately, so you don't have to deal with so much high time preference clientele.
Correct. But we could create the Breedlove, right, Austrian ETF, and we could compete directly with Spitznagel. There's no real barrier to entry if you have the capital and you're willing to seed it. You're willing to get the right attorney and get the right custodian. I don't think it's rocket science to run a basic version of this Austrian portfolio yourself.
Oh, interesting. Well, yeah, I couldn't help, but I sort of had the same thoughts as you when I was reading this book. I'm like, why is he not talking about Bitcoin? Like, if you had one of these Austrian investing strategies, one or two, just denominated in Austrian money, it seemed to make all the sense in the world. Or maybe not denominated in, but well, clearly you would report, because ideally it would be outperforming Bitcoin. I don't know if it actually would, but you would report your position in both dollars and Bitcoin, I'm sure. And then Bitcoin would also be a component of the fund.
Yeah. I mean, if you're running a consumer facing fund in the US for the foreseeable future, you're going to be reporting your returns in dollars.
For sure.
Because that's where you're going to be raising your capital. The entire reporting structure is based around that. You could definitely evolve the fund over time to report in Bitcoin, but I don't think anybody should be investing in anything with the idea of trying to beat Bitcoin, right? Because I think that's going to be a loser's game. Just like trying to beat an index of equities is pretty darn hard over long periods of time, because a naive strategy sometimes beats the most sophisticated strategy. And so just the naive strategy of saying, hey, I think Bitcoin's the best money in history. I think it's the most important Austrian investment, by the way. It's not in the book, but it's the most important investment an Austrian could make in the future. And I know a lot of Bitcoiners say that Bitcoin is savings technology. I don't necessarily disagree with that, but the reality is it's competing for capital flows from other assets that people consider to be investments. So it basically sort of becomes a moot point. Like, you can call it savings, you can call it an investment, but effectively it's competing in the investment marketplace, because a lot of the capital that comes to Bitcoin comes from those other places. But most people will do quite well by simply holding Bitcoin and skipping all equity, tail hedging, all ROIC screens, right? All entrepreneurial endeavors directly. If you already have capital, probably a big chunk of it should be in Bitcoin.
Yeah, absolutely. And it's, during its monetization phase, it's just kind of sucking all the air out of the room. Like, it's going to draw capital flows out of all these other investments, but long run, it's not technically an investment, it's money. So, interesting kind of semantics issue there. And then, it's funny, everyone still thinks in dollars and denominates themselves in dollars, but I tweeted this out the other day. Like, I'm at this point in my own thinking where if it don't make sats, it don't make sense. Like, what? Because otherwise you just hold Bitcoin, right?
Well, fiat cash flows can make sats, though. They're just
of
one
course,
step from conversion, right? So there's still value to building fiat businesses, right?
I guess I'm focused specifically on the investment side. Like I still generate a fiat cash flow and have, fiat real income and all of that. But just looking at your capital nest egg position, like you want to be growing that in terms of sats. Otherwise, you're not doing it right.
I'm not going to disagree with you. I don't want any more heat from the maxis either, Robert, honestly.
I don't give a shit about that so much. It's just, I don't know. I feel maybe like I'm identifying with Spitznagel as like very ruthless, almost free market capitalist and trying to gain as much territory on this network as possible. Like clearly respecting, like within a moral framework, I'm not going to go out and like $5 wrench attack people to try to get some Bitcoin because I just don't think the risk and reward is there. And clearly there's a moral line, like you'd be violating property rights, which is the whole philosophical and ethical case for Bitcoin is you're re-implementing inviolable property, which I think is the root cause of many problems in the world, central banking, et cetera. But within that bound of, life, liberty, and property, I want as much Bitcoin as I can possibly get. Because if this thing is going to take over the world, this is legacy, intergenerational type wealth.
I think the application of the Spitznagel approach for Bitcoin would be effectively 99+% Bitcoin and then 1% Bitcoin or 0.5% of Bitcoin put options rolled every couple of months. Because you can, the options markets are more healthy, right? There's more liquidity every day to justify doing that. And therefore you could take advantage of those swoons that happen on a much more condensed time scale. I mean, you see 20% drawdowns in Bitcoin, even in bull markets, like every couple months.
Yeah.
And so actually that strategy may work better. It just depends on how those options are priced, right? Because the S&P 500 is so liquid and because the volatility is lower and because those extreme events are more rare, the options are priced at the right level that you can buy them at a very small percentage of the overall portfolio, 0.5%. I think because Bitcoin is more volatile, and my suspicion without having done the work is that those options are priced at a high enough level that it would be harder to run the strategy, but it still might work in Bitcoin.
But the big risk there would be the opposite, right? Like a Bitcoin having a really bombastic move to the upside, and then you actually get exercised.
Well, if you just own long put options, you just lose your premium. You don't have to lose any of your Bitcoin because you just have the right
you're
to
just
sell.
Buying the option, you're not selling.
Yeah, you're buying the puts, right? So you're buying the right to sell Bitcoin. So you would buy, let's say, 2 month out, 25% or 30% below. So if Bitcoin dropped from 50,000 to 20,000 suddenly, right? Then those puts would pay, and you'd be able to turn around and use that capital to acquire more Bitcoin at 20,000. Right. And so
none of the options selling, that would be.
But what you are doing over time is dampening your long-term returns. Because if Bitcoin ultimately ends up at 2 million, 3 million, 5 million or whatever, right? There's a chance that the cost of running that additional option strategy, depending on how it plays out, actually costed you return relative to just a pure buy and hold strategy. Right. For some people, though, the emotional benefits, and by the way, emotions are not left out of the Austrian tradition, right? Yeah. A number of the great Austrian thinkers talk a lot about emotions and the role they play in time preference and economic decisions, et cetera. But so one reason to actually own puts on Bitcoin is simply so that you can sleep at night and not worry at all about short-term movements, because in effect, if Bitcoin goes down enough, your hedged tail hedging strategy actually pays off and allows you to acquire more Bitcoin.
Right.
So you can actually be happier, when the market falls. If the market goes up, you slightly underperformed a pure buy and hold strategy, but who cares? Maybe that cost was worth you sleeping well at night, and controlling your emotions actually allowed you to ride the 20-year journey or the 30-year journey of Bitcoin's monetization versus getting scared out like a lot of people were in 2017, 2018, and probably will be again at some point.
Yeah. Excellent point. But I guess, to your earlier point, it's just whatever is going to give you that peace of mind. Because I feel like now actually thinking through the strategy out loud, I feel like I still may get more peace of mind just being in a pure Bitcoin buy and hold.
Well, you will, because you have deep conviction that goes beyond the price. Your conviction is not a function of the price. Your conviction is a function of very deep work on the first principles of Bitcoin, understanding its properties, understanding energy, understanding the history and the context of other monies. And so you also understand that the linkage between Bitcoin and fiat is a short-term phenomenon.
Yeah.
And so the pricing that you're seeing on the screen is actually the product of distortion itself.
Yeah.
Right. And so until Bitcoin fully monetizes and becomes truly one Bitcoin equals one Bitcoin, and Bitcoin's actually reflected by the real world assets and outcomes that it drives. Right. So can it actually build a home? Right. Can it actually acquire an energy asset in the real world? And you get away from this second order version of Bitcoin's value, which is, what does the government's money printing machine say about the value of Bitcoin? Right. Because as Ross Stevens and others have said, right, it's not Bitcoin that's volatile, it's fiat that's volatile. But that volatility on the fiat side reflects itself into Bitcoin and makes it appear that Bitcoin's actually volatile when it's actually the exact opposite. So again, like for you, Robert, your strategy of just being long Bitcoin, owning Bitcoin, keeping it as your sound money for 10, 15, 20, 30 years, maybe at some point you liquidate some to buy a surfboard or whatever, right? Like that probably works for you. But for somebody else who's more freaked out by volatility, who hasn't done the work, who doesn't understand Bitcoin in context, who doesn't understand it at a deeper level, a tail hedge strategy like what Spitznagel's applying may help them dampen the volatility of their emotions, which then allows them to experience the full long-term return string of Bitcoin in a way that they wouldn't otherwise.
This is interesting. Like, I'm reminded here of that concept, linguistic relativity, which I think is also called the Whorf-Sapir hypothesis. But basically, the language that you think in has some influence on the very thoughts you can have, actually. So actually, the German language is known to be one of the most sophisticated languages, and we've had some of the greatest thinkers in the world that speak German because that language lends itself to very sophisticated thought patterns. Whereas something, like more romantic languages, Spanish or Italian or something, they're less scientifically useful. But I was just thinking here, it's like, okay, because I'm thinking in sats, I'm having an entire different viewpoint on Bitcoin versus someone thinking in dollars that would actually be concerned about price volatility. So it's like,
it's not just a different viewpoint, Robert. It's an entirely different experience.
That's what I'm saying. It's a different software install.
Yep. Yeah. I mean, I'm like, to be totally candid, I'm not fully there yet. Right. Like, I don't price everything in my life in Bitcoin yet, because I don't have a translation point from my Bitcoin wealth to my traditional wealth, my offline wealth, my fiat wealth. I'm a business builder. I have equity in 60 or 70 companies, including a lot of private companies. I mean, that equity value, I see it, I know it's there, but it has no impact on my life. I don't even know how to translate that to Bitcoin. I'm hoping that some of these companies, when they ultimately go public or they get acquired, that a big chunk of that will end up in Bitcoin. Yeah. But I couldn't even begin to tell you what I think that's worth in value, because it's just such a different,
too many unknowns.
Such a different world.
Yeah. And to be fair, I denominate my capital position in Bitcoin, but when I'm day to day eating lunch or buying whatever, I'm still thinking in dollars too. But I try to just have this very, short-term dollar P&L, I guess, the flow, my economic flows in life, I'm thinking in dollars, but then my economic stock, I'm trying to denominate in Bitcoin, if that makes sense. No, and I want to see the stock expanding all the time in terms of sats. So
with you on that.
Yeah, dude, this has been an awesome conversation. This book, I highly recommend anyone that's got the patience and the fortitude to go read it, because as you can see by the conversation we're having here,
what I'll tell you the honest truth. The first time I read it, I had a high time preference in that as an investor, I wanted to know the answer. Yeah. Right? I wanted to know the strategy. And even though I was a history major and I love reading about history, I struggled to really digest all of the Chinese philosophy and all of the Napoleonic era military strategy and all of the depth of the Austrian economic tradition. But thankfully, Robert, because I had to be prepared, I didn't want to be underprepared for somebody that my wife calls the Bitcoin professor. I actually really sat down, and for the first time in a long time, I spent the whole day yesterday just thinking about and notating this book. And a lot of the value is actually not in the naive kind of Austrian strategy that Spitznagel advocates for in the final 2 chapters. It's in all of the roundabout way in which he builds up these concepts and ideas, and the way time pervades the entire book, the way time preference, the way thinking about human action and human incentives, understanding the linkages between all of those to get to the final strategy. It allows you to, from first principles, actually look at your own investment strategy and dissect it a little bit more. So I found myself going back through some of my recent purchases, like Vertex, this pharmaceutical company that has a very high ROIC and was temporarily trading at a relatively low multiple over the last 6 months that I've been accumulating, and kind of re-underwriting it with this Austrian ideal in mind. And that's where the real value is. I was able to think through it all the way from the beginning again, and actually ask myself whether that made sense or not. And turns out it does. It checks a lot of the boxes. But thank you, because if I hadn't been talking with you about it, I would have been left with sort of more of a high level overview. And now I actually felt like I relearned some things by reading this book. So I highly recommend that people check it out. The Dao of Capital by Mark.
Now, let me ask you, the first time you read it, was this pre-Bitcoin for you? The first time you read it?
No, it was post-Bitcoin. It was a couple of years ago. Yeah.
Have you experienced Bitcoin, or I don't know, it's not necessarily Bitcoin. It's not like you just learn about Bitcoin and your time preference lowers, but it's something about interacting with it or thinking through it or studying these concepts around money and Austrian economics. Have you found and experienced that contributing to a lower time preference in yourself?
100%. But I would say that I already had a low time preference before. That was a learned behavior from my mother, who was an obsessive piggy bank style saver. Right. Unlike it's funny because the dynamic of my childhood is my dad was an aggressive, by the seat of your pants entrepreneur, like constantly swinging for the fences. And my mom was this very conservative, rigorous, disciplined saver and investor. And so I kind of bifurcate. Like I'm a entrepreneur. I play offense like an entrepreneur, and I go out and build companies and like to take risks. But on the other side, I'm kind of like my mom. Like I've always been with a very kind of low time preference, long duration type of thinker around investing. And so Bitcoin made more sense once I understood what it was, right? But it wasn't like I needed to change a lot. I just actually needed to spend the time to understand it. Before I understood it, I looked at it like the dot-com bubble, because my historical analogy, the thing that it reminded me most of when I first saw it was dot-com stocks, because that's what I was trading in my Stanford dorm room in the late 90s. But once I understood what it actually was, I realized, oh, this is something that I absolutely have to own because it's consistent with my existing values. I believe in things like living below your means.
Yeah.
Right. I believe in things like making long-term, or longer duration style investments. That's really what seed stage investing is. I mean, you oftentimes don't get a payoff for 10 or 15 years. Like what's more long duration in the economy than that? Like putting money to work today that you may not see again. Yeah. That even if you're successful, it may take 15 years to have it come back.
Right.
That said, like being on Bitcoin Twitter, interacting with Bitcoiners, listening to your podcast and others have definitely helped like reshape and help me understand with more depth, like where those, principles come from, like why they matter. Right. And what the end result is of having that lower time preference over time. So I would say owning Bitcoin's accelerated a lot of inclinations I already had before Bitcoin.
That's really cool. Yeah. So there's another way to think about Bitcoin, maybe, is the ultimate piggy bank.
It is. It is. On a point-to-point basis, it's the best savings device in the world. Yeah. Probably ever.
Very cool. Well, Mike, thanks so much for coming on. Could you tell my audience where they could find you?
Just at Mike Alfred at Twitter.
Simple enough. All right, dude. Thanks again.